All right, let's get straight to it. The market's hitting all-time highs, but if you look under the hood, the internals are showing significant tension. So here's a framework for how to think about positioning over the next 1 to 2 weeks.
Let this number sink in for a second. $7 trillion. That is the amount of cash currently parked on the sidelines in money market funds. Now, this is a classic double-edged sword. It's either the rocket fuel for a massive year-end chase, or it's a giant barometer telling us just how cautious the big institutions really are.
So, the multi-trillion-dollar question is, where does all that capital flow next? And what's going to be the catalyst that finally forces a decision? That's exactly what we're here to do. Build a clear framework to help anticipate that next big move.
Okay, first things first. We have to dive into the market internals. Why? Because the signals we're getting right now are, well, they're completely contradictory. You've got the major indices telling you one story, and the volatility market telling you a totally different one.
And this is the core divergence right here. The S&P 500 is printing brand new all-time highs. But at the same time, the VIX, the so-called fear index, is still elevated, sitting around 17 after a recent spike above 20. Now, for the VIX to be this high while the market is at its peak, that is not normal. It screams underlying fear. It means traders are chasing the market higher with one hand while buying up protection with the other.
And if you want a perfect example of this fear, look no further than this trade. An institutional player just scooped up 129,000 VIX calls, with a 33 strike expiring in December. Let's be clear, this isn't a small hedge. This is a massive conviction bet on a major volatility event happening before the end of the year, and it's completely at odds with the price action we see on the surface.
All right, let's zoom out to the macro picture, because this is where the tension is really building. There are some huge drivers on the horizon that every single institution is watching like a hawk. You've got 3 key dates you absolutely have to have on your calendar. First up, this Wednesday, we get the ADP private payroll data. That's our next look at the health of the labor market. Then, in December, we've got the final FOMC meeting of the year. That's going to set the tone from the Fed. And then there's the wild card, a Supreme Court ruling on tariffs that could literally change the game on trade policy overnight.
Now, beyond those immediate events, there's this bigger, slow-moving storm on the horizon, de-dollarization. You have major players like JP Morgan publicly stating this is underway. Now, this is a multi-year story, not something for tomorrow. But you better believe it's shaping how the big money is positioning for the long haul, looking for assets outside the US dollar. And speaking of big money, how about Berkshire Hathaway sitting on a record $382 billion in cash? When one of the world's most prominent value investors is hoarding that much dry powder, what does it tell you? It's a massive signal of caution. It says they believe much better buying opportunities are coming.
So we've seen the macro tension. Now let's drill down to the company level, because this earnings season has been, well, it's been brutal. The market is being incredibly selective, and it's ruthlessly punishing stocks even on what look like strong reports.
Take Palantir, for instance. The company comes out with a revenue beat and a stunning 121% growth in their commercial business. So what happens? The stock drops 3%. Why? Because the market immediately pivoted and said, yeah, but what about the valuation? A great report simply wasn't good enough. Or how about Ford? The market didn't even care about their quarterly results. It completely ignored them. All it saw was weak forward guidance, and boom, the stock gets hammered for a 21% loss. And then you've got biotech, where the risk is just binary. It's either a hero or a zero. Sarepta Therapeutics, they released some disappointing details in their report, and the stock is instantly chopped down by 40%. It just shows you the all-or-nothing environment we're in right now. And this last one, this comparison really tells the whole story. You've got 2 gig economy companies. Uber drops about 6% because of weak guidance. Meanwhile, Upwork skyrockets 19% on strong results and strong guidance. The message couldn't be clearer. Right now, forward guidance is the only thing the market cares about.
Okay, real quick before we get into the scenarios, the standard but very important disclaimer. This content is for educational purposes only. We're aggregating public info to help you stay informed and sharpen your own decision-making. Please do your own research. This is not financial advice. Okay, so with all that in mind, let's pull it all together. Here are some actionable scenarios for the next 1 to 2 weeks. This is the framework for how to navigate this tension. All right, here's the game plan. My base case is a choppy grind higher.
The key level to watch is the VIX. As long as it stays below 20, the plan is to be cautiously long, but keep about 25% cash. Now the bull case, the year-end chase, that gets triggered if the VIX collapses below 15. If that happens, it's a green light to deploy cash and increase exposure. On the flip side, the bear case kicks in if the VIX breaks and holds above that 20 to 21 level. That's your signal for a risk-off event, and the response is simple: move to cash and deploy hedges.
So really, what we have here is a classic tug of war between two powerful narratives. The bull thesis is that $7 trillion in cash can't sit on the sidelines and will be forced to chase performance into year-end. But the bear thesis is just as compelling. At some point, these extreme valuations have to matter. And all it takes is one catalyst to flip the switch from FOMO to a full-blown risk-off panic.
So, using that framework, let's walk through 3 specific risk-defined option setups that are designed for exactly this kind of environment. First up, a VIX hedge. And let's get the warning out of the way. Options carry substantial risk, and your losses can absolutely exceed the premium you pay. The thesis here is to hedge against a sharp downturn, aligning with that large institutional bet. The structure is a VIX December 33/40 call debit spread. It's a risk-defined way to play for a vol spike. And your invalidation point? If the market shows weakness but the VIX can't break and hold above 20, the thesis is likely broken.
Second setup is a post-earnings play in Uber. The core idea is that the post-earnings drop was an overreaction and the stock is attractive at these levels. The structure is selling a cash-secured put, for example, the November 22nd expiry at the $65 strike. You're taking advantage of that jacked-up implied volatility. You either get paid to wait or you get assigned the shares at a cost basis you're comfortable with. Just remember, a close below 65 results in assignment, so you have to size for ownership. And third, a leveraged play on precious metals through a miner like First Majestic Silver, ticker AG. The thesis is straightforward. If money flows into metals, the miners often give you a bigger bang for your buck. A possible structure is a January 30/35 call debit spread. You're exploiting the operational leverage these companies have. And your kill switch for this trade is simple. If spot silver breaks key technical support, the thesis is busted. And just to be crystal clear, none of this is trading advice. This is just a market update to keep you informed. All markets carry risk. You have to trade your own plan, manage your downside, and verify all data. And hey, if you found this framework helpful, please take a second to like and subscribe. It really does signal the algorithm and helps the channel reach more people. Your support is greatly appreciated.